Hi, everyone, and welcome to the IndianCatNatura webinar, Climate Disruption, Agriculture, and Crop Insurance, What are the Connections? My name is Rich Myers, and I'm an outreach specialist for the National Center for Appropriate Technology, which is kind of a mouthful, so most people know us as InCat. InCat's a nationwide nonprofit organization. We have 6 regional offices around the country, and we work on issues pertaining to sustainable agriculture, sustainable energy, and sustainable communities. This webinar was advertised for an hour, and it'll probably take 50 minutes or something like that, but we're going to add some time at the end, 10 or 15 minutes probably, just to make sure that everybody has a chance to ask a question if they want to. In fact, midway through the webinar, we're going to be taking a short break for questions up to that point, and then we'll continue after those questions are answered. When that happens, you'll see a field on the screen where you can write questions during the webinar, and I'll collect the questions, and Jeff will answer a number of them, both in the beginning when there's a break and at the end of the webinar. And I would just like to say, don't be shy about asking questions, because if you ask a question and it isn't answered during the webinar, we will answer it, and all the questions we get via email in the days to come. In fact, if you think of questions after the webinar, or really about any sustainable agriculture question, look for the Ask an Ag Expert contact information on the ATRA website, which is www.atra.incat.org. And if you missed that address, don't worry about it. We'll have it on the screen toward the end of the podcast, or excuse me, of the webinar. The webinar is being recorded, and it will be available on that ATRA webpage. ATRA is a sustainable agriculture information service that InCat runs through a cooperative agreement with the USDA Rural Business Cooperative Service, and I'd like to say we are grateful for their support. ATRA offers a wide range of services to sustainable ag producers, including webinars and publications, toll-free helplines, videos, podcasts, databases, quite a few resources. And once again, you can check it out for yourself on the website. Okay, today's presenter is Jeff Szysinski. And Jeff is an agricultural and natural resource economist. His work includes publications and education on crop insurance, conservation, national agriculture public policy, transgenetics, which is genetically modified organisms, blockchain agriculture supply chain management, soil health, biochar, and the role of agriculture in climate disruption. He was past elected member of the Organizational Council of the National Sustainable Agriculture Coalition. He was also the executive director of the Big Hole River Foundation and the Western Sustainable Agriculture Working Group. He's been an adjunct professor, or an adjunct instructor, at the Montana Technological University and Montana Western University and the University of Montana. Jeff built his own straw bale house and greenhouse. He raises poultry, and he's been a commercial beekeeper. Before moving to Montana in 1991, Jeff worked for Rutgers University and started one of the first CSA farms in New Jersey. He received graduate degrees in agricultural economics and political science. He served in the Peace Corps in Belize and worked many summers on his grandfather's dairy farm in Wisconsin. Whew. Okay. I think it's time we get it started, so I'm going to turn things over to
Jeff. Good morning or good afternoon, depending on wherever you're joining us today. This is going to be an interesting webinar for me and for you. I have been working on crop insurance for about this is my 17th year. And some mornings I wake up and I wonder what in the world I did that for. And in the morning I wonder if it would be better if it all would go away. To that, I'm going to read a quote from a very interesting paper. It's a little bit dated 2011, but I'll start. Principally, when facing impending harm, 3 things can be done about it. First, We can see to it that it never happens by addressing the causes of the harm. Second, we can adapt to the situation and do our best to ensure that the potential harm is not actually felt. Finally, we can allow the harm to happen, but compensate those who suffer it after the fact. There's a clear order of desirability here. Other things being equal, ceteris paribus, it is preferable to make sure that the harmful development never happens. Second best is to adapt to the development and make sure that it is not harmful or less harmful than it would otherwise have been. Least desirable is to allow the harm to happen and compensate for it afterwards. The title of that article is Why Most Climate Insurance Schemes Are a Bad Idea. I hope that's not a good prognosis for this webinar, but we'll see. Yeah, it would seem almost axiomatic to the answer to this question would, of course, be yes. Although having just noted what I said, maybe we should think about that a little harder. First, and it's an important thing I probably don't say enough, but that crop insurance is only one way to mitigate risk. So there are many other ways to mitigate risk. You can buy a bin, store your thing. You can use hedging, they call it, for protection in markets. You can buy your inputs in advance so that you don't have to suffer price changes in those inputs. Different kinds of investments can be different ways. So insurance isn't the only way. Unlike car insurance, you're not forced to take out crop insurance. And you just simply might not, because you can reduce risk. Also diversity, replanting, hedging, etc. I am going to be using some jargon, and Rich will note if you say, what term did he use? I can hopefully I won't use them too much, and I won't use acronyms too much, but you tend to do that when you spend so much time in a field. You tend to pick up the jargon. Revenue risk is something I talk a lot about, and it's not customarily discussed that way, but it includes what I call both risks associated with yield and price. And now yield is the one we most think of, or yield risk, because that's really what crop insurance is about. It's often called multi-peril, because what that means is there's all these multiple perils: droughts, too much water, too little water, temperature, freezing, all the things that can affect crops and even livestock, forage, and all those things. And those affect the yield, which then ultimately affects revenue. And then, of course, when you plant something or you birth a cow, you know what the price is at that moment or when you plant, but by the end, it could be very different, lower or higher. So you always have a risk. The last risk that we often talk about is the input risk, which is simply that you have input prices change, and that affects bottom line. Risk Management Agency, or RMA, hopefully you're familiar with that organization. It's the kind of main USD agency that works and sets the rules and monitors the crop insurance program, along with the Federal Crop Insurance Corporation, which is a kind of a weird kind of organization set up by kind of a corporation set up by government. And then there's liability, the value of what is insured, and rarely does one have insurance that covers 100%. Well, in crop insurance, we're getting with supplemental crop policies closer to sometimes up to 90, 95, but very rarely 100% coverage for your losses. And liability is the value of what is insured. And indemnities could also be just the payout for insurable losses. Climate. I have the fortunate advantage every single day to travel 40 minutes one way over the Continental Divide into Butte, Montana. I get to go through the Deer Lodge National Forest twice a day on most normal days. COVID has interrupted that somewhat. But this is what I would see in one of my views. In fact, I took that on the way over one time in the summer, obviously. But you can see, if you look carefully, it's not a great picture. I'm not a good photographer. Anyway, it's a lot of tree death, and that's from a pine bark beetle. Now, there have been pine bark beetle augmentations through the history of forests, so it's not only climate disruption, but there has been a pretty strong linkage made by scientists that because you don't have as cold of winters, the pine bark beetle doesn't die as easily, therefore it survives longer and it starts to decimate forests. And I can't estimate how much, but there's a lot of dead trees in there. And you can see the ones that are brown, you can see the ones that are gray. And it is kind of unnerving when you do that every day and you actually watch, that's been almost 18 years of watching that. Here's another thing I maybe have nightmares about or dream about or think about a lot as an economist in natural resources is our greenhouse gas emissions, which are, really mostly, not entirely, due to the use of fossil fuels in our economy. In fact, when this is a period 1850 to 2017, these are non-renewable finite fossil fuels, and they are the problem. We went up this hill, and now we got to go over this hill and come down another side. And we have to do it, many scientists say, fairly quickly. It took us quite a while to get up there, but it's quite of a hill. And so we have quite of a challenge ahead of us, I would argue. Here's another way to look at climate change. Many of these different kinds of pictures. I found this one a bit interesting because of the blue spot, which is suggesting that if you take the average precipitation differences between blocks of time, 1991 to 20, and then compare it to 1981 to 2010, and you do some comparisons there, you can kind of see trends going and how the things have gotten wetter there in Montana, which I've worked in for many years now, and work with farmers here. That's semi-arid dryland cropping systems, but you can see that eastern Montana, which is pretty dry most of the time, has had some more. So, the climate, we know that things are getting warmer. We're not quite, I think most of the climatologists I've read, not quite as easy to predict changes in precipitation. And there are some interesting trends. You can see the Southwest and California definitely drying up and more, and some places getting greener. But again, it's, this is a picture and a way to look at some of the climate, is over time. Weather is what you see out your window. A meteorologist told me that once. A good distinction to remember. And then this is the other thing. These are the interesting things I like to look at, crop indemnity maps. You can do these I'll give you the IRM website. They have a lot of these. You can do them for different years, all kinds of different ways to run this. But this is the most recent one on February 1st. They put this out every 15 days or every month. Anyway, the darker ones is remember, indemnities, payouts. These are the counties. Unit of analysis and insurance is counties. So this county level data will spread over the 3,000 plus counties in the United States. And you can see that, there's indemnities being paid all over the country. And this is from last year. And so you can see that the Red River Valley in North Dakota and parts of Nebraska suffered, I suspect, maybe some prevented planting, some precipitation early in the year, or possibly other. You can see Iowa. If you look at Iowa there, you can see what I would think is a dark band across Iowa. That might be the derecho that everyone has heard about. You can also see along the Mississippi River, a lot of flooding there often that causes losses. You can see the panhandle of Texas and Oklahoma and western Kansas, which are very dry arable systems. They use summer fallow. They dependent on an aquifer, the Aguagala. I never can say that right. Aquifer. They are probably, my experience, is one of the most riskiest places to grow crops in the country. And that's kind of what you can do by looking at the dark brown, or where last year anyway, where things were very risky because we paid out a lot of compensation. Some people might ask Arizona and Nevada. Nevada is due to a new product that's fairly new called Rainfall Index, or Forage Index Insurance. I won't go into that much, but it's a cool way to for livestock forage protection, and it's being used. And I think that's why you see there was losses, because forage must have been affected. Arizona is probably a combination of forage, and also apples was a big loss. I looked these up specifically, and I didn't know that Arizona was one of the major apple producers in states in the country. Always learn something with crop insurance. This is the basic system for crop insurance, which is federally subsidized. It's a public-private system. Some days I wonder if we got the worst of both worlds when we did this, but it's the way it is. It's kind of, I view it as kind of a giant nonprofit system with kind of profit motive underlying it to some degree. You have private insurance companies, those accredited insurance providers, the 14 companies that provide through their companies, through independent agents or direct agents. They provide they manage and service the products for us, and the RMA kind of sets the terms and rules. They negotiate a fee for that, so they make money providing that service. They also sell their own private products, which are kind of interesting to look at. They're very special. Hail, for instance, is really all private, and so hail insurance is usually a private property policy and not subsidized, therefore. Anyway, they pay the administrative costs. That's kind of a pass-through. They collect the premiums and they pass through. But also, a thing I should point out is that private companies also have kind of a bit of skin in the game here. The Federal Crop Insurance Corporation and the RMA, they pay the private companies if there's what they call an underwriting gain. The law is that RMA tries to set premiums across all their products such that in aggregate, overall, they take in as much as they pay out, so that there's no net loss and there is no necessarily net gain. It's not like other private insurance companies, not trying to make a profit. It's just trying to break even and what they call be actuarially sound, which simply just means they try to set that so that they're not making more money than they are paying out more than they take in. But some years you obviously pay out more than you take, and that's called a gain, and that gain is shared with us. So there's a little bit of skin in the game that that motivates the individual agents to try to lessen their losses by selection of the clients they serve to a certain degree. That's another whole topic in itself. So availability of crop insurance. Lots of policies seemingly covering lots of crops and livestock and different kinds of risks, but let's look at corn. Corn is probably, I think it's close, corn and wheat. More counties provide good revenue protection, RP for short, and other yield and other coverages for corn in all of these counties. I've watched this change over the years, and it's always amazing to me, like, who's growing corn? And I can kind of remember in eastern Montana, except along rivers where there was irrigation, there wasn't all that much corn grown. Our seasons, the heating degree days and all that, and there's varieties. But now we're growing corn almost everywhere, and that in itself might be an issue. But notice that it's available and very good revenue protection, two kinds of risk. But here, when I grow my fresh market tomatoes in my greenhouse, if I want to sell them, I don't grow that many because it's not very easy to grow them in Montana, which is why I can't buy insurance for it. Look at the little tiny green dots in Florida, California are the biggies, and you can see these couple counties spread out through the United States where you can get fresh market tomato, and it's really, in fact, all of it is really just yield protection, no risk protection for it. And so from Montana, I can't get a yield protection for my tomatoes. But it also shows you kind of where all the tomato production is. Obviously, that's why the insurance seems to be there. We know Florida and California are big fresh market tomato producers. But there is one product that I'll spend much more time on, and the love of my life, so to speak, whole farm revenue protection, something I did work on for 17 years, and you'll figure that out why as I go along here. But it is the first crop insurance policy that's available in every county in the United States for any crops, which I'll get to. By the way, I didn't include Alaska and Hawaii. They should be there. They are part of the United States, just that the maps often leave them out. I'm sorry, Hawaii and Alaskans. Follow the money. Another thing that's kind of interesting about is who pays and who gains in crop insurance. Again, lots of types of policies, different ranges of federal support and risk covered, but the dominance of revenue protection. This is 2020. Total liability coverage was $113.8 billion. That's the value of the crops that were covered by crop insurance. That's a lot of money. And only 5 specific types of policies. 90% of total liability coverage were covered by 5 types, and they are yield insurance, what they call yield. These are 2 types of policies: yield protection, APH, which tends to be specialty crops. Anyway, it's kind of a funny name, but it is just basically yield protection, and that's 20.8 billion. Revenue, again, the yield and price risk, or RP, 76.3. That one alone, i.e. the dominance. Whole farm, which is a kind of revenue insurance, which I'll get to a little bit later, it's 2.2 billion, not nothing in terms of the value of crops covered under it. This parametric index, remember I was telling you the losses in Nevada and probably Arizona, they're related to this forage index rainfall, or RI. It's kind of protecting the forage, and it's indexed because it triggers by data of rainfall, not by actual losses appearing on exactly on your place. And that's 3.2. But again, all of the other policy combines are only 11.3. And subsidy is significant, and it varies by the type as well. As you can see, this is from 2020 data. Again, the revenue protection being so dominant, $17.2 billion in premiums paid out, and 64% of that was paid by taxpayers. Yield, again, these two yield, specific yield policies, but 0.4, a lot less in terms of total premiums paid. Pretty high level of subsidy, though. Whole farm revenue, my favorite product, 0.13, not a lot of premium, pretty well subsidized as well. And the parametric, a little less subsidized this last year. Again, significant amount of subsidization. Federal subsidies also are captured by a few crops. And you can see this by 2020, the liability, again, the value of the crop: corn, soybeans, cotton, wheat. They represent 88 billion, or 77% of the total value of what was insured by our federal program. I threw in apples because they're a, quote, specialty crop, fruit crop. They aren't as covered as well as many of them are, but apples is probably one of the most covered, actually covered by whole farm revenue. That's another story, but 1.5, again, billion, so pretty low and pretty highly subsidized as well. So the distribution of benefits is another issue. And in all of this, I'm going to tie back to climate. Believe me, I'm getting there. As defined by USDA, mid-size, large scale, and non-family farms, i.e. corporate farms, represent about only 10.4% of all farms in the United States in 2019. But these farms received 78% of crop insurance payouts in that year, indemnities. That's a source. Most of the above were program crops, which are listed there. Those crops really have benefited greatly from crop insurance. And a good reference, it's a bit dated, but excellent. Colleagues of mine, both of these folks, 2 of them, all of them, I should say, are from Montana State University. I forgot that. Beckerman, Smith, and Belasco are all from Montana State University. So I'm shouting out to my fellow colleagues who do great work in crop insurance. So now time for a few questions. I'm going to summarize here at this point. Public benefits of crop insurance accrue to larger crop farms, few single program crops in the form of revenue protection. And here's where I'm starting to suggest this tends to incentivize monoculture or biculture, and they may not be as resilient as we would hope. Growing specialty horticulture and the various ones they don't actually get, and they tend to mitigate their risk in other ways, which might be better. And it's hard to judge if climate disruption brings what it brings, whether they will be able to adapt and be as resilient as they have been in the face of climate disruption without easily accessible insurance. So, Rich, any questions?
Yeah, we have a few, but before I get to the questions, I realized that I forgot to tell you this, tell you folks this in the introduction, is at the end of the webinar, you'll receive a short survey. And it's really important to, if you can, to take a few minutes to answer this survey. We use them to help make our future webinars more effective. But Jeff, I combined 2 or 3 questions into one question in the interest of time. So it's kind of a multi-parter a little bit.
All right.
Basically, so what if most of the crop insurance subsidy benefits are captured by larger farms and the 4 major commodity crops? Don't they deserve risk protection? And aren't they producing most of the productive crops in the country?
Well, in the later part of that question, most of the productive crops in the country is somewhat debatable. I mean, specialty crops, cashews, almonds, even apples, they're very high valued crops. So there's quite a bit of risk in losing those highly valuable crops if you don't have insurance. And as I showed in the map, for instance, highly valued fresh market tomatoes, you only have a few counties in the whole country where you can get, and then they only yield insurance. So the bias affects, in a sense, it's not about value. Yeah, it's true. I'm not suggesting that necessarily, although the implications for climate has to be thought to take away the great risk protection for our few commodity crops. It's just to point out that that is a reality. And of course, those are very valuable crops. And of course, they have risks. But and we'll get to this later, if it's incentive, if our public policy incentivizes kind of staying the same and not changing and adapting in the face of climate disruption, is crop insurance in a sense getting in the way? But more on that later. Any other questions, Rich? I hope I did that some service.
Yeah, I think we're good to go ahead with the.
All right, I'll
rest.
move on.
Okay.
Now here's something that is going to be one of these wonkish, in the weeds kind of things that people always tell me I get into too quickly, but I think it's a very critical issue when it comes to climate disruption and its relationship to crop insurance. This is a definition of good farming. It's in the RMA, or the USDA's definition of what a good farming practice is in relationship to crop insurance, mind you. I'm not saying this generally. This is I call it the RMA fine print. And I'm going to read a little bit of this, but you can read it along and pay attention to the red part. Good farming practices. First of all, they're not mentioning specific things here, but the production methods utilized to produce the insured crop, and quote, and this is the important, allow it to make normal progress towards maturity and produce at least the yield used to determine the production guarantee or amount of insurance. And again, there's all these other things about, the experts that you can check with and call your insurance provider or the company that provides the insurance to make sure and, determine this for sure. But if you think about it, what's important about it is that red part, normal progress towards maturity. And the reason that is that way is that because premiums are, for all of the products, revenue, well, with exceptional farm, are kind of based on a yields, on your historic yields. They're called your actual production history. And of course, setting those premiums you always have to look backwards to get a sense for where they should be set, so that you make that, that actuarial soundness where you pay out more than one overall anyway. And so, they want to know that if you change the way you farm and you're going to disrupt your historical revenue history, by maybe trying something for a few years and lowering your your productivity based historically on your yield, well, that could start to, they'd say, oh, why are you doing something funny and weird? If you do something funny and weird, then all our models get thrown out of kilter, and we don't know if those are legitimate things you should be doing, and blah, blah, blah. And it goes on like that. And it's been a huge issue of late with cover cropping. I'll get to that. And it also is a huge issue when it comes to conservation, and therefore, ultimately, I think some issues around climate disruption. Now, this was supposedly changed in the 2018 Farm Bill, and I argue that this issue has not been settled unless at some point RMA changes some of these definitions. But the use of NRC conservations, if you read the first half before you get to the red, that's kind of what people think. Oh, that's okay. Therefore, use of NRC's conservation will not have any impact on federal crop insurance. If you stop right there, that might be clear. But notice that they keep going on. Provided, you got to watch those provisions, that provided, the fine print, the adoption of such practice does not, again, negatively impact the insured's crop ability to make normal progress. So, according to RMA, is cover cropping a good farming practice? I can't see how many times I see every day cover crops is, going to build a resilient system, and it's going to, save us from climate and all of that. But then we've got this problem that, well, if you go cover crop, your yield might drop. You might be doing something that doesn't make you have normal progress towards the historical yields that determined your revenue guarantee. So is it or isn't it? For the most part, they kind of come over, but then they still have all these guidances. You got to go check the experts. I mean, how many farmers want to, if they're going to try cover crops, they want to talk to their agent, or they have to go through an extra bureaucratic thing, or they got to crack somebody at a land grant university and say, is it okay if I try cover crops? And well, when do you terminate? Well, we have guidance, but then the farmer says, but I don't want to do it when you tell me to do it. I think I need to do it when I need to do it, otherwise it's not going to work. Anyway, that's just cover cropping. In Montana, I hate to say this, and I'm probably get in some trouble, but organic farmers, grain farmers, big farms in Montana are starting, and others, even other in the regenerative movement, are trying this interseeding, planting two crops at once, and that really messes up RMA. They just don't know if that's a good farming practice, and to my understanding, unless you get blessed in special dispensation, you could jeopardize part or all of your crop insurance by, if they discover it, you're interceding in terms of a practice. And then the question is, just is organic farming a good farming practice? Because that involves a lot of strange things that might interrupt. I mean, eventually you'll be an organic farmer and you'll develop a yield, and that will be reflective of your organic practices. But when you make that first movement, it's a pretty big disruption of your normal yields. And is it any sustaining farming practice or anything innovative? Is that good or bad? And here's some even definitions of the RMA, organic farming practice. It's very specific to the organic rule. And then sustainable, which is distinctive from organic, because they say, well, everything excluding organic is sustainable. But again, it's necessarily to check with those agricultural experts. By the way, ATRA program and therefore NCAT, we are labeled, and in the law and in part of the documents, we are listed as an organic farming practice expert. So if you have some questions about your good organic farming practices and crop insurance, feel free to call me. I love to talk about crop insurance, as you can tell. So given this system of crop insurance, how can one meet the climate disruption challenge? Kind of got to look into the past to look to the future. Is the answer. Now, I'm going to go offline to another site, to some really cool tool that I hope all of you will explore on your own. And I'm just going to give you a little taste of it this morning. This is a really cool tool. I like cool tools. This is called the Aggress Viewer. It was developed by some really clever guys at the Southwest Climate Hub. As you know, there are many climate hubs around the United States. Actually, all the other folks kind of helped with this too, but we got to give credit to the Southwest Climate Hub for putting this together. And what it is, it's limited. I hope they update it. Currently, it runs from 1989 to 2018. It's a pretty good range of data. And of course, if you're going to think about climate, you got to think over a longer time. It can do some really cool things, like it can basically show you up to the county level. You can see all the counties in there. You can see the causes of loss. You can see the causes of loss for a certain commodity. You can see it for subsets of years or for the entire year. I'm going to look at causes of loss here, and I'm going to set, and I preset it to, well, I'm going to do decline in price. Remember, with revenue insurance, the decline in price is a risk that is covered. And it's always been curious to me, and it was really cool. I could look at this over the whole time and say, well, how many times does that kick in, that decline in price, that revenue, that price risk that comes into play? And I can just update this map, and after choosing that, and then it shows me the counties where cause of loss over that period of time due to decline in price. And it's interesting. You kind of make all kinds of interesting, researchers love this because you can all kinds of ideas about what does that mean, that revenue. Like if I look at Eastern Washington, it could be grain issues or it could be apples, because I know whole farm revenue is used a lot in Washington, and there's a lot of volatility in the prices of apples because of international markets and other things. So they're collecting on their losses due to revenue losses. You can see also that it's serious in the Midwest as well. And this gives you the total amount of money, essentially. This tells you the amount of the indemnities paid out for causes of loss. And you can play with this with all kinds of different ways, and you can do this thing where you can just look at a kind of aggregate level. So you can look at this cause of loss thing at a bigger level, and then you can really see that revenue. That's why revenue insurance is so popular. Look at the Midwest and all those commodity crops, and Texas, this area here I was always talking about, and maybe apples and grains in the Washington area. Anyway, I am now going to go back, which is going to cause me to probably, it worked perfectly. Okay, so going on, I really think check that tool out. I mean, just think about it. If you're a farmer and you want to look at the causes of loss. If you're particularly a beginning farmer, and you're thinking, well, should I have crop insurance or not? Well, what's the risk? Well, look at the history, and maybe looking at the last few years, if we compare it to the early years and last years, so we can see trends. And again, here we are moving towards understanding climate. Unfortunately, it doesn't necessarily help us with prediction, but it does help us to see the direction things are going. So I have this essential question, and this is now getting into climate issues and disruption. Is the ability of farmers and ranchers to adapt to climate-friendly practices or systems of production primarily constrained by economic factors, including federal crop insurance subsidies and the financial risks of implementing different crops and practices and systems of production? And I take this from a great dissertation of a guy in Iowa. I think Iowa State 2017 is a reference. I draw heavily on this part from that work. It's great work. And I did look at there's a lot of research. Well, not a lot, but there's some. Most research on Midwest, first of all, when you ask this question, most of it is on commodity crops to begin with. We don't even talk about the apples and specialty crops in terms of that issue. Well, we might not be talking about it because, again, they don't get very good insurance, therefore nothing to investigate in terms of the influence of insurance over crop choices. Crop-specific subsidies significantly affect crop diversification. And I would say insurance too. Farmers respond to the incentive of lowering growing costs by replacing, or lowering risks by replacing existing crops with the subsidized crops. Hence, corn and soybeans, mono and biculture, very much reinforced by our current structure of crop insurance. By specializing, farmers may be able to capture product-specific economies, but they may reduce their ability to manage risk or capture economies of scope. I'm not going to get into the economic difference of scale, of economies of size and scope. But there is a distinction, an important one. Scope has to do more to do with diversifying your risk across the enterprise, and economies of scale, as it implies, has to do with that your costs are distributed over a higher volume. And we have captured in a lot of our commodity crops, most of the, I would argue, most of the economies of size, and this may be reinforced by crop insurance. Crop insurance likely changes land use, more management land. It's a debated issue and a lot of some different things on that, but it's definitely worth more research. And again, that could have climate implications. We could be breaking out more land, releasing the carbon sequestrated in the soil if crop incentives are going the wrong way. And this is just a very specific thing of this guy's research. My results also confirm federally subsidized crop insurance as the primary source of a farmer's coping capacity. Whew. Now, if that's true, and the incentives are to grow more monobicultures, and the only way I can cope is my revenue insurance, am I getting trapped and not being able to challenge and adapt to the future of climate disruption? So whole farm revenue is my solution. And I like it and I liked it since 18 years ago or 17 years ago when I started this whole thing. It ensures the whole farm's revenue based on the average of your revenue history, not your yield history. It's basically saying, farmer, rancher, grow what is most profitable for you, or combinations of the way you want to grow, besides, and mitigate your risks by either growing more or different complements of crops, and then we'll just protect you because because it's risky. We know about culture is risky, but we're going to protect you. But we're going to protect, in a sense, your revenue or your income, and it covers both those things that affect your yield, both price and yield. It improves, the subsidies improve, incentivizes as you have more, you get a higher level of you have possibility of higher level of coverage and more products. Premium rates, cost of the thing lowers with each added product up to 7. They kind of stop at 7. I'm never really quite sure. I guess after that, 9, 10, 11, it's kind of moot in terms of the difference, I guess, or they just arbitrarily pick 7. And it covers, again, every county, every place, and really almost every single kind of crop and livestock. You can, if you don't have it on the list, you just say other crop and you can insure it. That'll cause your cost to go up, but anyway. And it does have a limit in terms of coverage, which is still pretty high. And this is used by a lot of different, and also for organic, it incorporates, because your history is organic, your values are incorporated in your history. It's a really cool product. And here's some research we did, great study of 5 years. Is organic farming risky? Great study, 160 some pages, excellent work, a couple published papers, I love it. But this gives you a sense of the different crops, and really 65 distinct products were covered with this one policy. And you can see that some policies that you wouldn't even expect are dominant. Apples, that's a whole story in itself. We can't go into it. Someday I could tell you more about that one, but you can see that there are a lot of commodity crops in there too. Quick thing to show it works. This is a made up Vermont, Bennington County. County is the unit of analysis. Organic farm, because that's my favorites. Apples, beets, carrots, cipollini, and eggs. It's a cool thing about whole farm. It also creates livestock products, because again, we're not caring about what you grow and whether livestock or not. We're really talking about, all of it in terms of its value. And so this is what they expect to produce. And you can see that their historic 5-year average, 170. So they think they're going to do a little bit better than average in the coming year, or this last year. And the premium for this would have been $13,000 to cover that 170,000. Well, it's actually a little bit less because it's only 85% of that. And the premium it's pretty well subsidy there, good subsidy for it. Again, it kind of gives us overview, expected revenue. Let's say they had a 50% loss. This is just showing how it paid out. That 144 is the 85, 172. You get indemnity payment of 58. So you made 86, you get 58 from the insurance. But you got to put in the cost of the insurance. Actual net revenue is 138. So basically, this guy, by taking the insurance, recovered about 80% of their revenue. Now, this doesn't work the same for every single example. I can contrive the example to make it look better or worse. And so you really have to run through with your insurance agent, your specific history, your specific complements. This is just an example. But what's also really important, and that's why there's not much crop insurance sold in the New England areas, is that the only alternative for insuring those crops besides whole farm revenue would have been apples. And that's a yield-only policy. It doesn't even include revenue. So without whole farm revenue, there wouldn't really be much insurance available. And since whole farm revenue has its own problems, which they aren't still using it very much, they have figured out how to mitigate risk without insurance. And diversity matters. If I were to take that same farm and reduce it to only 3 products, apples, beets, and eggs, the premium would increase. Makes sense, not putting all your eggs in one basket. So if there are less eggs, you can break the eggs more. Anyway, you get a 16% premium. That isn't a uniform discount over every system. It depends on the crops you're talking about. But in this case, it does move towards discounting for diversity. So conclusions and conjectures. Crop insurance is highly subsidized. So in thinking about the future, some people say, well, we could just, if they use cover crops, we can lower their premiums or we can improve their coverage. Well, you're getting really good insurance already. And the marginal ability to motivate behavior change by just adjusting premiums or those things, I have my questions about whether that will be useful. Also, system change may be necessary, polycultures. And current crop insurance programs maintain the current system. It's kind of the nature of the beast. It's based on history, therefore it wants to push the history to the present, but possibly we need, with climate disruption and erratic weather events and those things, we need more resilient systems, and yet we're enforcing mono or bicultures and using a lot of public dollars to do that. Too good crop insurance, like revenue protection, and it's really good insurance. I can explain why if somebody wants to ask me. Can also do this marginal land, again, with implications. This whole good farming rule makes adoption of new climate-friendly practices systems difficult. I would argue that there needs to be a change in that definition so that we can actually encourage innovation rather than not. Equitable distribution, the benefits seem skewed in a direction that may not support climate adaptation because it's going to the bioculture and monoculture crops that are kind of embedded in a system that makes change difficult. And that's reinforcing the inability to change. Whole farm offers a financial system for this diversity, and I think perhaps what might be a way to build more resilient farms based on just crop diversity alone, crop and livestock diversity alone. Whole farm may be particularly beneficial to organic farms. Again, more organic farms are growing crops that aren't covered, and they also, in my opinion, tend to build more resilient systems because of the diversity and use of cover crops and other practices that others are trying to adopt these days. My personal vision, so I'm taking my hat off as an employee, but something from 18 years, I think a reformed, and there are problems with whole farm revenue, don't get me wrong, there's many problems with it, and we've tried very hard for many years to improve it, and we're making slow, incremental progress on that. But I wish it would become the dominant form of insurance. I believe it would lead to the kind of resilient systems we need, and it would actually, I haven't proved this yet by research, but I think it would lead to less total public expense for our crop insurance program. We need whole farm and other conservation programs incentivizes farmers to adopt certified organic systems. I think that and beyond, organic systems are a direction that have an inherent great kind of climate resilience. So we need the kind of programs and insurance that supports that direction. Here's their website. It's a really good website. A lot of tools there. I love their tools. Play that, explore. We have lots of resources in IndianCatNatura on farming, and we have a whole section. I think it's one of the better ones around in terms of all of these issues. And there's my contact information, which I'm just going to put up there for a moment. you can again look into the recording if you didn't get it, or call me. And please take the survey. Take the survey. And thanks. Questions, Rich?
Yeah, we had three people ask a similar question to this. Um, have you examined increasing premiums for producers with more frequent indemnities? The same as auto and home insurance.
The good analogy. Yeah, they, those ads when they kind of like personalizing insurance, like if you're a good driver and they put a little meter in your car, so you could put a little meter on on the farm and says you're doing good things, and then it's called risk pooling. The problem is, of course, yeah, if you were in a private business of insurance, you would probably want to, what you want to do is you want to bring into your pool of people insurance all the ones with the least risk. And therefore you can charge the same premium, make more money because they're not going to have a claim, right? So, and you want, some people kind of want to pick those people out and do it, and vice versa. If there's the farmers that aren't kind of doing a good job and they're creating more of the risk. But the problem is that it's so locationally specific. So it would be, you could do it. I mean, I guess with big data and things these days, you could actually try to figure out, but and you could try to adjust indemnities. There's all kinds of, because it's a public-private thing, you got to be careful. I mean, if for instance, if some folks in Texas start feeling like they're getting charged more for their crop insurance than neighboring Oklahoma or Arizona or whatever, then they start getting upset, or New Mexico, I should say. Anyway, they get upset, like, why are they getting a better deal? And of course, we look at that history, you can see those places where it seems to be losses after losses after losses. And of course, they do in those places adjust premiums upward. So they again hit that overall, they call the loss ratio 1-to-1, where they try to get as much coming in and coming out. And of course, that has to be jiggered every year. And of course, sometimes when there's like a nationwide drought, in 2015 it was, or whatever, 2014, yeah, 2015. Anyway, that just doesn't matter what he did. It was a lot of losses. It was up to like $14 billion in claims in that, because it was a big pervasive drought across the entire country. So, and those are the things that, you can't predict as easily, and that might be the reality in the future. I didn't come around exactly that answer. I mean, it's a doable thing, but I think the policy would be difficult and it would cause kind of consternations between folks. But I think the general premise of readjusting premiums to really take light of the risks, that at least provide for lower cost public cost, but it doesn't necessarily just fundamentally address the fundamental structural issues that the current system is incentivizing, I would argue.
Okay.
Thanks. Good question.
Yeah. The next question is, it seems like we would want to offer premium discounts for transitioning to more water efficient crops in drought prone areas, sorghum versus corn, for example.
It's a really good idea, and of course, if you didn't move the whole farm, it might be another direction to go. My issues with that would be that, of course, then you would be starting to differentiate between saying, okay, these people are doing better, they're less risky, let's give them a better deal. The problem is you already have really good deals for a lot of crops. And first of all, irrigated crops, not all, but some tend to be special crops that don't even have coverage at all in many places, as I was showing you. So that's another issue. The other issue is that, you're going to start setting up certain types of people against other types of people, and maybe that legitimately is right. I think a better way to go, in my opinion, though, is to get away from this structural incentive where the benefits are accruing only to a few crops, which is so good. I mean, I hate to say it, but growing corn, soybeans, and wheat, I know farmers pay a good percentage, not 100%, obviously they get a good subsidy, but they have skin in the game, and that's a beauty, I think, of crop insurance in general. At least the farmer has skin in the game, whereas if you just give a direct payment or something else, there's no behavior change, and you still give them, they just get it because they grow corn. And at least with this, they're in it. And it is a possibility, and of course that's where a lot of the things are going. They're going towards this idea that, well, if I use a cover crop, I'm going to give you some premium or coverage advantage, and of course that will, that means you either got to pay more for the whole program because you're not going to take an incentive away that you already have given out, so you have to add. But then incrementally, if you think in a marginal context, are you marginally giving a little benefit that's going to really push somebody to do something significantly different than they're doing? I was actually on a conference event going on earlier today, and a farmer, a very innovative, certified organic, big farmer in Indiana, said, don't use crop insurance at all, because if you want to do these regenerative programs, they're not going to cover you. That was a pretty bold claim, and I don't know if I'm that bold, but that's like I say, some days I wake up and I think, if it all went away, we'd be better off, and then people would mitigate risk for the other reasons, to no harm, as I was pointed out in the very beginning, rather than waiting for the harm to happen and compensate. But boy, that's a complex issue to get into. But thanks for the question. I don't know if I gave it justice, but I tried.
Next up, could premiums be adapted to account for more resilient, might be the same sort of question, to account for more resilient farming practices, such as no-till with cover crops and building soil organic matter?
That is what's going on in the public policy sphere right now. That is some of the biggest arguments, that's what we should do. And again, I'm going to come back to that. Yes, you can do that. Of course, you have to have a nationwide agreement on what actually is the best sustainable practices. I mean, I could make a personal argument to say, if you're a certified organic farm, you should get a premium discount just because you're a certified organic farm, because in general, I would argue, they are more resilient farms. And we actually have a way to define them because it's legally defined. So let's give them a premium discount. Now, think of the political economic ramifications of doing that. People are going to say, what? Why are you doing that for them? Well, you pick anything. Cover cropping, there are people, organic farmers have been cover cropping for years. People are adapting it more and more. It's a good practice. I have nothing personally against it. It's just that a lot of people aren't using it. And why aren't they? In part because they're not giving incentive. But can we give them incentive if they already got really high incentives? Can we give them more incentives without taking incentives away to change? Remember that essential question? How do we nudge behavior with public policy and crop insurance? In some ways, maybe it's not the best way to do it at all. That's what I started with, and that's radical for me to say when I kind of get invested in the whole thing. But it's again, it's doable, but not easy. You would set up farmers against farmers, and why bother when you would have coal farm revenue, which does not set it up based on what you grow. It's just saying, look, you need to cover risk, and what's the biggest risk you have? That you might lose the farm. If I give you insurance that protects you from losing the farm, you can farm. Then you figure out how to grow and to maximize your profit. Don't let public policy tell you how to do it. Kind of have empathy for that guy that says don't buy it at all, just do the better practices. I have a little empathy for that. But at the same time, there's catastrophic losses that are going to probably occur for that guy in Indiana. And someday he may have a derecho come through his wonderful farm that's resilient, and it's still going to, or have a drought or a huge rainstorm or whatever. And maybe he will then think, gosh, I wish I had insurance. I always make this really dark joke. People always hate insurance until their house burns down. And you know that the probability of a house burning down is incredibly low, but we all buy insurance, or at least some of us that are more risk averse, or not risk averse, risk gambling or whatever. All right, that was not a good answer, but an answer. maybe.
Huh,
Thanks, Rich.
sure. We have some more questions. We are right now at the hour.
Oh, we did
We've
pretty
kind of
good.
let people know. You want to do a couple more before we
Sure,
let
I
folks
love
go?
questions. I love this topic. You know
Okay.
me.
Yeah. Um, how is or are the RMA and banks adjusting existing insurance programs for different climate change scenarios?
Oh, they're working on it. Believe me, that's how they make money. So they're working on it, but it's hard to work on. Everybody knows this, but there are insurance companies for insurance companies, and the insurance companies for the insurance companies, they they spend more of the time with these really elaborate models and these really things to try to predict. And so they kind of feed into the system because they underwrite. So an insurance company says, well, what if I make a mistake in setting the premium and I lose all, I lose all, I have to pay out more than I took in, and it doesn't even cover my investment, and pretty soon I'm, bankrupt. That actually happened in the 2015 to federal to the AI, one of the couple of the AIPs. They basically, it was a huge, that drought was fantastic. I mean, fantastic, incredible, and they almost lost their shirts, and we had to bail them out because they were kind of this public-private thing, right? And but yes, they are. I mean, if banks are all about estimating risk, that's how they make money. And they don't make investments in risky things, or at least they want to cover that risk as much as they possibly can. And insurance is pretty much the same. And so these underwriting and these insurance companies. So bottom line, even with a public-private system, I would predict, and I think I'd be pretty safe in saying that crop insurance premiums are going to go up. Farming and agriculture is going to get more riskier than it is, and therefore they ultimately, if you're going to pay for that risk, again, maybe we have to consider the first two things to do less harm, to build the systems prior, so we don't have to wait for the harm and then pay the compensation. But we need a little bit of maybe of all of those things to be working on this.
Okay, and we have a question that might be a good sort of a wrap-up question, I think, which is, what do you think are the limitations of whole farm revenue protection in its current form, and what could be
Boy.
done to? Is that a big, broad
Yes.
subject?
No, that's not a very broad subject, because I know some really quick answers that may not be totally understandable by everyone. One of the biggest problems is, and I get tired of hearing it, it's too much paperwork.
Mm.
And that's just too generic of an answer, because it's more complicated than that. That is an answer, but there's a lot of paperwork with most crop insurance. I mean, tracking your actual production history over time, that's paperwork. It's just that those paperwork systems have been kind of routinized and computerized and digitized and softwared, and nobody's bothered to, like, I tried a couple times to create systems where I can make the policy writing easier for folks. Agents don't like it because they don't know it. They have to write up. There are more forms, but they're easy. They could be easily digitized. It isn't so much the paperwork. That's just an excuse, in my opinion. The biggest problem is that it has, here's how the paperwork works. Unfortunately, RMA has suggested that they have given the power to the insurance company to say, the basic way they look at your history is to look at your tax forms. And they say, okay, your average productive capacity to generate revenue is this average. And now we even changed that a bit. But anyway, 170,000 that we did in the example. Well, if they have allowed the agents to say, if you don't trust their tax forms, you can demand all their records back to that 5 years to make sure that they weren't screwing around with those tax forms. And they allow them to do that. And of course, they will do that. And they don't even have to have any excuse to do it. In fact, they're almost encouraged to do it. Well, then the farmer's got to dig out all that paperwork to justify their tax forms. I mean, it's hard enough sometimes for people to expose their tax forms to their agents, but now we're going to dig deeply into whether they fill out their tax forms right. They don't want to go there. If you have a lot of crops, if you have 5, it's not so bad, or you have 20, it gets worse, to track all of that. And they just let them do this. And then if you're going to go, what you're going to do in the future, they say, well, how do you know you're going to get that yield? How are you going to, if you have the history, it's okay. If it's a new crop, you have to go find some other place. You've got to find out a way to justify both what you expect to get and what you historically have gotten, and they have made that more cumbersome than they need to. They can just use the, I say just use the tax. For the other thing they do, which is really serious, it's 50% of the problem at least, is they make them track their expenses through their tax history. There's no other crop insurance policy in the United States that's publicly subsidized that requires a person to document whether they spent the right amount of money on their inputs to cover, or they get penalized if they don't spend the right amount and they're trying to get a claim. Unfortunately, Whole Farm Revenue does that. It makes them track their expenses, another set of paperwork that they don't need to do because no one else has to do it. And then they not only do that, then they say, if you don't make 70% of your historic expenditures in the year of your insurance, we're going to start penalizing your payout. You think that makes farmers or ranchers happy when they go to get a claim that all of a sudden, well, you didn't spend enough on your inputs, or even no matter whether there was explanation for that or not, they should just wipe that out. And we have asked RMA and the USDA to do that. And they say they don't really have a good answer. I think they have some answer about paranoia of cheating or something, but no one else does that. That has just added an extra layer of burden on the paperwork that doesn't need to be there. So yes, it's paperwork, but it's more than paperwork. There's some other things that we've made. We have a whole very concrete, well-researched list of ways to reform and improve whole farm revenue. And it'd be my life's dream to see them adopt them all. But politics is an incremental business, and we work at it very, very hard. And hopefully that vision will come true. Thanks.
All right. If you're up for one more question, scrolling through the questions.
Okay.
I'm sorry. I'm throwing you a curveball here.
That's not right. No problem. I love curveballs.
I'm scrolling through the questions. There are quite a few people who talk about the hesitancy that insurance agents seem to have concerning selling the whole farm policies.
Yes. Yeah, I have to laugh at that. Check out our Is Organic Farming Risking Report. It's a really great report. We actually, we specifically interviewed a pretty good sample of all this cropping agents about whole farm revenue. And because it's a public thing and it's government, I can't say exactly what one insurance agency said about whole farm revenue, but it wasn't nice, and it involved curse words. That's probably enough. But then we've had others, and I actually think it's by age. The younger people starting out in the crop insurance business, the way you make money in crop insurance business is developing clients and then having those clients basically renew their policies, because every time they renew a policy, you get more money and you don't really have to do that much work. So you build a client base and then you renew and you be friendly and you help them. And so the younger ones seem to be more interested in whole farm revenue because it's a whole new area. Think about it. All those crops in all those counties that don't have fresh market tomato coverage, that's potential business for you. I often tell these insurance agents, and then the older guys, of course, they're selling corn revenue policies in Iowa. That's the one I didn't like it, by the way. And he said, well, I can write these up really fast, and I got all these renewing policies, and I'm making money, and I get the underwriting gains. Why in the heck would I want to sell this crazy policy? Now, they legally have to, but of course, you don't want to go work with an agent who despises the product, even though he's legally obligated to sell it to you. So you got to search out the ones that are, and they tend to be the younger people who want to build a business on this. I think there's a great opportunity for the crop insurance industry and for the business. Again, if reformed, which would also make it easier to make that all those filings and paperwork easier, and more education perhaps on how it works, and systematizing the way to write up the policy, which in today's world, we have TurboTax. My God, if we can do TurboTax, we can certainly build a software system to file a whole farm revenue claim and a whole farm revenue policy. It can simply be done if there is will, and the will is probably the more problem.
Okay, well, I think we should probably let folks go at that point.
Yes.
I want to remind people that we got quite a number of questions, and if we didn't get to your question in the webinar, we will be replying to them via email.
Jeff will
And
be replying them by email, by the way. Just like,
Jeff will be replying to. When I say we, it's not me, so you don't have to worry about that.
it'll be me. I'm the only one that knows it enough, I guess, to do it these days, unfortunately. Thank you,
yeah,
but I love the questions, so please bring them on.
and so another reminder about please do the survey. It really helps us out. And other than just thanking folks for taking part today in our webinar, I think we'll let you go. So thanks, Jeff.
Thank you, everyone. Have a good day. Stay safe.